Thank you, Mark. Federal Reserve leveled another big rate hike to battle inflation. With prices rising at the fastest rate in a generation, the Fed raised its benchmark interest rate by an additional 0.75 of a percentage point. It's the fourth time the central bank raised rates this year alone. Bottom line, the economy is hanging in the balance. Joining me on the morning show, Titus Pittman, certified financial planner with Genesis Financial Partners. Now, despite these fast and furious moves, I guess is what we can call them, the central bank has its work cut out for it. Goal is to rein in inflation without kickstarting a recession. Can they bring about a soft landing for the economy?
It depends. The Fed is walking a very tightrope, trying to tame price stability. You have, on the one hand, we have a strong labor market, the economy is doing well, but yet prices are out of control. It's at a 40-year high. If the Fed is able to rein in inflation by raising the interest rate and causing what's called price destruction, meaning you lessen the demand because you're raising rates and it makes it more expensive for borrowers to borrow money to purchase these goods and services.
Economists have already seen some promising signs. Some prices, like gas, are already coming down.
Yes, and that's happening because the president has talked to the Saudis. Other countries are putting on more supply. And when you have more supply and you have less demand, then prices begin to come down. So we're starting to see that here at the pump. We're also starting to see businesses cut back on spending, which is also slowing the economy, which will help with those price reductions.
Fed chair seems optimistic we can avoid a recession. You?
I'm optimistic. I'm optimistic because I say that the past doesn't always repeat itself, but it is data that we can glean on. And hopefully those data will allow us to make better decisions and have a better outcome here in the future.
You know, the housing market has ridden a roller coaster. And people look back and they say, well, are we in for what we saw in 2008? And most people say, no, it's not going to be like that. But they do say that the housing market right now is in a recession of its own.
I would say yes to the first thing. We're not in the same situation we are in 2008 because those loans that people made back in 2008 was what we call no-doc loans. There was variable rate interest loans. People have the benefit over the last 4 or 5 years to lock in very low rates. So I don't see that. But I do say that the housing market in a recession, because if it becomes more expensive for people to buy these homes and get mortgages, then of course you would have a very sharp decline in the housing market.
Stock market reacted very favorably yesterday to the Fed's moves. Both the Dow and the NASDAQ were up 400+ points. Sure. Next couple of days, there may be a little bit of a course correction, but let's look into the crystal ball. Fourth quarter, will we see some correction? Because people want to know, what do I do with my investments? They're kind of worried because right now they see a big dip.
Sure. I mean, this year has been challenging for most investors. I would say that over the next 2 to 3 months, the market will digest what just happened. If we see inflation begin to start coming down and businesses continue to make some meaningful investment and the labor market stays strong, I do see a rebound in the fourth quarter that could happen.
So, you know, anytime you talk to a financial planner, basically they tell you, look, you get in this for the long term. So sit tight, don't panic, don't make any rash moves. Still the best advice?
Still the best advice. I mean, investing is a long-term prospect. If you have 2 to 3 years, look at these as entry points. When the market pulls back like this, these are opportunities for you to slowly dollar cost average into the market. These investments that you buy today that are down in price, over the next 12 to 16 months, these investments will appreciate if you buy quality companies.
Okay, so people say, all right, I look at the numbers, I see that the Dow is down. The markets in general are down. What did you tell me?
About 20%, yes.
Do they rise to their previous highs and maybe even go higher?
It's a very good possibility. If we don't hit a recession or a mild recession, I see these same companies begin to make capital investments into the markets, create their profitability, and then these companies will also rise, which would help the market appreciate in value 20 or plus beyond that.
You know, I read an article, and I think it was in Forbes magazine, and they said, you know what, retirees look and they say, okay, I'm going to live off my principal, but that may not be our reality in the future. The 40-year bull market that we've enjoyed may not be the long-term reality.
Yes.
What do you think?
I would think that it's important to reassess your overall financial goals. COVID has changed a lot of things. Inflation historically has been 2 to 3%. There's talk now that inflation now may be 4 to 5%. That may be our new norm. So if that's the case, that your investments you have may need to be reallocated to make sure that you're getting growth as well as income to help produce that retirement income that you're looking for.
So just what, annually?
I would say we typically look at our investments quarterly. You may make annual changes, but quarterly is a good rule of thumb to reassess your overall financial situation and your allocation inside your portfolio.
But again, don't panic. Don't react to what's going on right now?
Bruce, I would say I'm a study of history, and I look back in the past, and when I see things like this, even though this is different, it's still familiar. And what I've seen that if you have quality investments, you're diversified inside your portfolio, that this too shall pass, and the market is always positive over a 3, 5, and 10-year period of time.
Titus Pittman, good advice. Thank you.
Thank you,
Appreciate
Bruce.
Jen.